Welcome aboard, ladies and gentlemen. My name is Peter Yusuf. I'm the senior analyst of IronFX, and together we'll be going through a webinar about the week ahead. Now, before we start anything, I'll leave you to go through our risk warning and our disclaimer for a couple of seconds before we start. Now, we have to bear in mind that we're leaving behind us a week dominated by fundamentals, yet still financial releases tended to function as flashpoints. In the coming week, we maintain the view that fundamentals are still going to be influencing the markets, yet financial releases may have an increased importance on the bearing. We highlight on Monday the release of China's NBS manufacturing PMI for May, on Tuesday, Eurozone's preliminary HICP rate for May, on Wednesday, Australia's GDP rate for Q1, yet the crown of financial releases may be on Friday, the US employment report for May, which is expected to be closely watched. On the monetary front, we highlight the release of Australia's RBA interest rate decision, while on Friday from the US, Jerome Powell, the Fed's chairman, is scheduled to speak. Please note, as we are moving ahead, that you can download the handouts, the relevant comment. Moving now to the US dollar. This would be the USD Index for our chart. Note how practically the index has jumped in the past 2 4-hour sessions, 2 consecutive green candlesticks, especially the last one, which was magnified after the US core CPI rate was released, jumping above the 90.25. Note also that the index has broken the downward trend line characterizing its movement since the beginning of May. Hence, we would initially switch our bearish outlook in favor of a sideways movement between the 90.25 and the 89.65, but the upward motion, which broke the 90.25, forces us to switch the sideways bias in favor of a bullish outlook. In this case, should the bulls actually take charge, we may see in the coming week the index breaking the 90.75 and start aiming for the 91.30, which served as a considerable resistance level. And that was back at the end of April, beginning of May. Even higher than that, we note the 91.75 resistance line, which served the index mid-April. To the downside, once again, the prior upper boundary of the sideways movement now turned into support, the 90.25. Even lower, it's the lower boundary of the past sideways movement at 89.65, and even lower than that, we note the 89.15. Now, in USD's fundamentals, the weakening of the USD seems to have hit a hold once again midweek after hitting a fresh new 5-month low. The hold may prove to be the main feature of USD's price action against a basket of other currencies, yet it still remains to be seen whether it's a turning point or just a recess. Fundamentally, the main issue is and remains the inflationary pressures building up in the US economy. The market seems to be focusing on the Fed's intentions and on whether the bank is about to start discussing a possible tapering of its QE program as means of tightening its monetary policy and thus tame the inflationary pressures. Hence, each Fed policymaker making statements is monitored for any hints on the bank's intentions. Thus, we highlight the scheduled speech of Fed's Chairman Jerome Powell on Friday. The unexpected acceleration of the headline CPI rate for April and the core PCE price index for April today confirmed the market's suspicions, and given the Fed's dual mandate on inflation and maximum employment, the attention may start turning to the release of the US employment report for May. Now, should a strong employment report be released for May on Friday, we may see the pressure on the Fed to act rising and thus supporting the USD, while should the employment data be weaker than expected, we may see the USD weakening as it would allow the Fed to maintain its dovishness, practically dismissing the inflationary pressures as temporary. Also in the USD fundamentals, we note the possibility of further tensions in the US-China relationships, which if present next week could provide the USD with some safe haven inflows for the greenback. Yet, besides of the US employment report on Friday, we would also like to note on Tuesday the release of the ISM manufacturing PMI for May. On Thursday, the release of the ISM non-manufacturing PMI for May and the weekly initial jobless claims figure, while on Friday, we get also the US factory orders growth rate for April. Moving now to the pound, and this would be cables for our chart. Note how practically cable has maintained a sideways motion surrounding the 1.4145 level. Currently, it's serving as a support level. Note how practically the level has held its ground against the downward pressure experienced from the release of the US core CPI index. Specific levels to keep an eye out would be to the downside, as we have mentioned, the 1.4145, which seems to be temporarily at least holding its ground. Lower than that, we have the 1.3990. And even lower than that, we have the 1.3845, which served the pair well. And that was around the 22nd, 23rd of April. To the upside, we note the 1.4275, higher than that, the 1.4390, and even higher, the 1.4530. Note that GBPUSD or cable, whatever you prefer, tends to trade already at rather high levels and may have some more bearish tendencies in the coming week, but that remains to be seen. Moving now to pound's fundamentals. Now, the pound tended to strengthen against the USD yesterday, as well as the euro and JPY. Overall, though, cable seems to maintain a sideways motion, as we have mentioned. It seems that comments made by BOE policymaker Flieger tended to provide tailwinds for the pound. In his statements, BOE's policymaker yesterday mentioned the possibility of BOE raising interest rates late in 2022 without excluding the possibility of an earlier rate hike, possibly in the first half of next year, should the job market bounce back faster than expected. On GBP's fundamentals, the easing of lockdown measures, along with the intense vaccination program, seems to continue to support the pound at rather high levels, while the spreading of the Indian variant of COVID remains a threat, yet its importance seems to have deflated somewhat recently. Nevertheless, news that the full reopening of the UK economy in June could be on the balance may still weaken the pound. It should be noted that the pound may be among the best performing G10 currencies against the USD since the start of the year. We intend to maintain our focus on UK's fundamentals and BOE's monetary policy outlook, given the low number of high impact financial releases in the coming week from the UK. Yet, we would like to note the release of the UK nationwide house prices for May on Tuesday, and on Thursday, the final figure of UK services sector PMI for May. Moving now to the Japanese yen, and this would be USDJPY for our chart. Note how the pair jumped during the early American session today. Important levels to keep an eye out would be the S100-995, which served as a resistance line in the previous days, yet now has been turned into support. Lower than that, I would highlight also the 109.25, and even lower than that would be the 108.35, which was the downward boundary of the past sideways motion. To the upside, we would highlight the 110.90, even higher than that, the 111.70, and even higher than that, the 112.25, all being found in the past. Moving now to JPY's fundamentals. We have mentioned that JPY weakened yesterday against USD, however, also against GBP and Euro, practically highlighting the troubles surrounding the Japanese economy. Words in the land of the rising sun are related to the path of the pandemic, the pace of economic recovery, and the Summer Olympics, while Tokyo's state of emergency may be extended. All of that seemed to weigh on the Japanese currency, at least on a fundamental level. Nevertheless, we should not forget JPY's dual nature, which besides a national currency is also considered as a safe haven. Hence, should the market sentiment turn more towards a risk-on attitude, it could have an adverse effect on JPY and vice versa. On the monetary front, we highlight BOJ Governor Kuroda's comments earlier today, noting the rising inflationary pressures in the US and the variance of monetary policy on a global level, highlighting that BOJ is to stick with easing. As for financial releases, we note on Monday Japan's preliminary industrial output growth rate for April, as well as the retail sales growth rate for April, while on Tuesday we get the final Jibun Bank manufacturing PMI reading for May. Moving now to the common currency, and this would be Euro USDs for our chart. Please note that practically the pair has dropped during the early American session due to the release of the US inflationary measures, which were better than expected, practically breaking the 1.2175 support line, now turned to resistance. Nevertheless, we tend to maintain our sideways bias, and that's at least until the downtrend seems to have started making more lower troughs and lower peaks. For the time being, important levels to note would be to the downside, the 1.21, which tended to serve the pair as a resistance and a support line. Even lower than that would be the 1.1990, serving the pair around the beginning of May. And lower than that, the 1.1885. To the upside, we would highlight the 1.2175, which served the pair as a support level, as we have mentioned, now turned to resistance. Higher than that would be the 1.2275, which was aimed for at least from the 25th of May onwards, and higher than that, the 1.2350. Moving to Euro's fundamentals, the common currency seems about to end the week more or less where it began, maybe with a slight drop today, indicative of the Euro's weakness to benefit from the improved outlook of the Eurozone. Yesterday, the common currency tended to weaken against USD, GBP, and CHF, as ECB's DeCoste statements were hinting that the area's inflationary pressures are of temporary nature, and Panetta's comments that it may be too early for ECB to taper its QE program maintained a dovish tone and may have invited the bears. Hence, we may see the dovish outlook for the ECB weighing on the single currency in the coming days if there is no mentioning of a possible tightening. On Euro's fundamentals, we note the improved pace of vaccinations in Europe and the lowering tendency for the number of new daily cases in Germany and France, the two largest economies in the zone, both supporting the better outlook for the Eurozone. As for financial releases, we note on Monday Germany's preliminary HICP rate for May, on Tuesday Germany's retail sales growth rate for April, and Germany's final manufacturing PMI reading for May, as well as Eurozone's preliminary HICP rate for May. On Wednesday, we get Eurozone's producer prices for April, and on Thursday, Eurozone's and France's final services and composite PMI readings for May, while on Friday, we get Eurozone's final retail sales growth rate for April. Moving now to the next chart, and that would be the Aussie against the USD for our chart. Now note how the pair has maintained a sideways motion, even despite the sudden drop in the early American session today, breaking the 0.7725. If we see in the wider spectrum the movement of the pair, we will see that it maintained the main body of its price action between the 0.7785 and the 0.7665, with the heavyweight being between the 0.7725 and the 0.7785. Nevertheless, for a sideways bias to change, I would require the pair to break below the 0.7665. Moving on to main levels to keep an eye out would be to the downside, the S1 0.7665, as we have mentioned. Lower than that, the 0.7595, and even lower than that, the 0.7530. To the upside, we note the 0.7725, which served as a support level in the previous days. And even higher than that would be the 0.7785, which worked as a resistance line in the past few days, as well as on the mid of the month. Higher than that, we would note also the 0.7850. Moving now to Aussie's fundamentals. The Aussie seems about to end the week on the lower end of its sideways movement against the USD. However, worries for the Aussie tend to run deeper, given the efforts of China to set the price of copper and iron ore under control to key export products of Australia. Overall, though, we would also like to highlight the preparations ahead of the Biden-Xi meeting in June, as well as the US-Sino relationships as a possible factor that could fundamentally affect the Aussie, and a possible escalation in the tensions characterizing their relationship could have an adverse effect. On the monetary front, we highlight the release of RBA's interest rate decision on Tuesday. The bank is widely expected to remain on hold at 0.10, and currently AUDUSD imply a probability of 99% for such a scenario to materialize. Hence, attention is expected to turn to governor Low's statement, yet we would not expect any change in the bank's dovish tone as prices seem to remain below the bank's target. Hence, overall, we would not expect any major changes. Such a scenario could weaken AUD given the bank's current dovishness and monetary outlook differentials with other commodity currency central banks such as BOC and RBA and US. As for financial releases, we note the release of China's NBS and Caixin manufacturing PMI readings for May on Monday and Tuesday respectively, while on Tuesday, we also get Australia's building approvals for April. On Wednesday, we highlight the release of Australia's GDP rate for Q1, while on Thursday, we get Australia's final retail sales growth rate for April. Moving now to the CAD, and this would be USD CADs for our chart. Note how the pair has in the past week actually broken its downward trend line, characterizing its movement since the last days of April. It was very intense and very characteristic. Also note that even the strengthening of the USD due to the release of today's inflationary measures failed to push the pair substantially higher, as it remained between the boundaries of 1.2140 and the 1.2060. Now, moving and mentioning the possible levels to keep an eye out would be to the downside, the 1.2060, which provided considerable support, especially yesterday for the pair, while to the upside, I would highlight the 1.2140, even higher than that, the 1.2230, and the highest level we have noted would be the 1.2320, which practically provided the resistance and capped the pair's upward motion a couple of times from the 3rd of May to the 5th of May. To the downside, we have mentioned the S1 1.2060. Even lower than that, we would highlight the 1.1995 and even lower the 1.1920. Moving to CAD's fundamentals. Now, the CAD seems about to edge lower against the USD as the week is about to end and is about to hold a string of 7 consecutive weeks where USD CAD was on the reds. Fundamentally, oil prices tend to be one of the main issues for CAD traders, given that oil is one of the major export products of Canada. It should be noted that oil prices are currently at rather high levels, yet could experience substantial volatility in the coming week. The OPEC Plus meeting should be taken into account on the 1st of January, and it's going to take place via video conference. The meeting is on a ministerial level and could reaffirm the gradual easing of production cuts agreed in the previous meeting, yet the possibility of Iran re-entering the oil market as a major exporter may place a shadow of a doubt on that scenario. On the demand side, it seems that the global economic recovery tends to support the notion of higher demand, thus supporting also oil prices. Yet it's not all about oil for CAD traders in the next week. Also, financial releases could affect the market's opinion about CAD's direction. On Monday, we get Canada's current account balance for Q1, and on Tuesday, the GDP rate on an annualized basis for Q1, as well as the market manufacturing PMI for May. On Wednesday, we get Canada's building permits for April, and on Friday, we highlight the release of Canada's employment data for May, as well as the IV PMI reading for the same month. And that should sum it up for the day. However, before we leave you, a small general comment as closure. Now, overall in the FX market, given the high number of high-impact financial releases, we may see fundamentals relenting some more or less ground and providing a more balanced mix for traders to watch out for. The USD is expected to maintain the initiative over other currencies, especially given rates and figures on Friday. Also, we would like to highlight any effect on the USD of the US yields, which tended to rise in the past 2 days, and should they continue, may provide some support for the greenback. On the other hand, rising US yields may weaken gold prices, as that the main indices, as they would highlight the opportunity cost for gold bearers. As for US stock markets, we highlight that the main indices seem to be on a make or break position with rather low volatility, albeit a bullish movement was present and must be noted. Should the market maintain a risk-on sentiment in the coming week, we may see the buying interest being extended and vice versa. Now, regarding your question and request practically to expand on US inflation and its impact on the USD, we would highlight the following. It's going to be more like a chain reaction. High inflation rates tend to put the pressure on the Fed to practically tighten its monetary policy. That could occur practically on two ways. Either the Fed is going to proceed with a rate hike, raising its interest rates, practically making loans costlier. In such a case, the higher cost of loans is going to be lowering the economic activity, thus lowering also inflation. The other option, which is more feasible, would be for the bank to actually taper its QE program. Practically, that would mean that the Fed would, in a sense, tighten the liquidity of the markets by suppressing the flow of cash in the market as such. Now, this scenario is widely discussed. The discussions have been coming and going since the headline CPI rates were released. Now, today, we also had the release of the core PCE price index. That's the Fed's favorite inflationary measure. That measure also accelerated. Actually, it was better than what was expected. It was higher than what was expected. And thus, the pressure on the Fed to actually start tapering its QE program, i.e. tightening the markets in the US, has been increasing. But the US central bank, the Fed, has a dual mandate. The Fed has to watch out for high inflation, i.e. keep it under control, but at the same time has to maximize employment. And for that purpose, it needs a loose monetary policy. So practically the only thing that still stands in the way between the Fed's argumentation and actually tapering the QE program, i.e. lower the liquidity of the markets, would be May's employment report, which is due out on Friday. Should practically the employment report for May show that the employment market is tightening considerably, i.e. new jobs are being created in a high number and the unemployment rate is dropping substantially, that could be further motivation for the Fed to start discussing its tapering program and thus could provide substantial support for the US dollar. I understand that that should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.